Gold just did something it has only done 3 times in the last 40 years. In a single 72-hour window, the gold to S&P 500 ratio moved by the largest margin since October 2008. Not 2020, not 2011, 2008. The last time this specific ratio moved this fast, the S&P 500 lost 38% of its value inside of 90 days. And right now, you're watching gold price at $3,100 per ounce, while the stock market is still partying like it's 2021. That gap, that specific divergence between what gold is doing and what equities are doing, is not noise. It is a signal. And once you understand what this signal has meant every single time it's appeared in the last 4 decades, you will never look at your portfolio the same way again. If you're watching this right now with your retirement account open in another tab, stay with me, because what I'm about to show you is not doom scrolling. This is data, and the data is screaming. I know a lot of you are confused. You're watching gold at all-time highs and wondering whether to buy, whether to sell, whether this is the blow-off top everyone's been waiting for. And I understand the confusion, because on the surface, gold going up looks like good news for gold holders and nothing else. But that's not the part that should concern you. The part that should concern you is why gold is moving. Because gold doesn't spike like this because investors love it. Gold spikes like this because smart money is running. And right now, the data shows that institutional money, the kind that moves in $500 million blocks, not $5,000 blocks, is rotating out of equities and into physical gold at a pace we haven't seen since the global financial crisis. Welcome to the hidden economy. We cover what the mainstream financial media won't touch: the paper versus physical divide, the East versus West resource war, and the institutional moves that happen before the headlines. If you're not subscribed yet, fix that right now. Hit the bell, because this channel covers the signals before they become breaking news. And this signal, the one we're breaking down today, is already flashing red. Let me show you the specific numbers that don't add up. Right now, the COMEX gold futures market, that's the primary exchange where paper gold is priced in the United States, is showing open interest of approximately 512,000 contracts. Each contract represents 100 ounces. That's 51.2 million ounces of paper gold outstanding. Now let's look at the registered gold in COMEX vaults, the physical gold that has actually been set aside for delivery. As of the most recent vault report, registered gold sits at approximately 8.4 million ounces. You do the math. 51.2 million ounces of paper claims, 8.4 million ounces of real metal. That is a paper to physical ratio of 6.1 to 1 on the registered side alone. If you include the eligible category, gold sitting in COMEX vaults that has not been committed for delivery, the total rises to about 22.5 million ounces. Even then, you've got more than 2 paper ounces for every real one. Paper says there's plenty of gold. The vault says something different. And here's where it gets interesting, because that vault number has been moving, not up, down. Over the last 14 months, registered gold at COMEX has declined by 31%. That's not a typo. 31% of the physically committed gold has been quietly removed from the registered category, moved to eligible, or moved out entirely. When metal leaves the registered pool, it means someone took delivery. Someone converted their paper claim into real, physical gold bars and walked them out of the vault system. That doesn't happen when people think the price is going higher and they can sell the paper for profit later. That happens when people don't trust the paper anymore. And that's not the part that should concern you most. The part that should concern you is who has been taking delivery. Because the delivery notices filed at COMEX over the last 2 contract months show that the bulk of physical offtake is coming from accounts tied to sovereign and institutional buyers. Not retail investors, not hedge funds running momentum trades. Sovereign-level buyers, central banks and their proxies, central banks, taking physical delivery from the U.S. exchange, while simultaneously the gold price hits all-time highs. Once you understand the ratio, the price action makes sense, but the ratio also tells you something else, something about what comes after the price action. Let me give you the full picture, because this doesn't start with gold in 2025 or 2026. This starts with a pattern that has now repeated itself with almost mechanical precision for over 4 decades. Go back to 1971. Nixon closes the gold window. The US dollar is no longer redeemable for physical gold. For the first time in modern history, the world's reserve currency is backed by nothing but confidence. And what did gold do in the years immediately following that decision? It went from $35 per ounce to $850 per ounce by January 1980. A 2,329% move in under 9 years. But here's what almost nobody talks about. In the 18 months before gold hit $850, the stock market, specifically the S&P 500, crashed 27%. And in the 6 months leading up to that gold peak, the paper-to-physical ratio at the primary gold exchange of that era had blown out to levels that prompted the Hunt brothers situation in silver, which shook the entire commodity complex. Same playbook, different decade. Fast forward to 2008, the global financial crisis. Bear Stearns collapses in March. Lehman Brothers collapses in September. In between those two events, gold is actually down briefly because institutional players are liquidating everything, including gold, to cover margin calls across their equity books. Sound familiar? Does that pattern match anything you've seen in the last 90 days? But here's what happened next. From October 2008 to September 2011, gold went from $730 per ounce to $1,921 per ounce, a 163% move in 35 months. While the S&P 500 was still recovering its 2007 highs. Once is accident, twice is coincidence, 3 times is policy. Now let's look at where we are in 2026, because the data points are stacking up in a way that should make every serious investor pay very close attention. Point 1. The Fed balance sheet. The Federal Reserve currently holds approximately $7.1 trillion in assets, primarily U.S. Treasury bonds and mortgage-backed securities. Despite 2 years of supposed quantitative tightening, the balance sheet has barely moved from its pandemic-era peak of $8.9 trillion. Compare that to the pre-2008 balance sheet of $900 billion. The Fed's balance sheet is nearly 8 times larger than it was before the last major crash. That isn't tightening. That is a system that cannot afford to tighten. And it gets worse. Point 2. The bond market. U.S. 10-year Treasury yields have been oscillating between 4.2% and 4.8%, levels that, historically, represent significant stress for equity valuations. When the 10-year yield exceeds the S&P 500's earnings yield, which it has done for most of the past 18 months, institutional money has an arbitrage. Why hold risky equities when you can get near equivalent returns from government bonds with theoretically zero default risk? The rotation out of equities has been underway. It's just been masked by the Magnificent Seven concentration effect. Strip out the top 7 stocks by market cap, and the S&P 500's trailing 12-month return is effectively flat. But that's not the part that should concern you. Point 3. The Shanghai gold premium. Right now, gold traded on the Shanghai Gold Exchange is commanding a premium of approximately $22 to $28 per ounce over London spot price. That premium, let's be precise, $22 to $28, has been persistent for over 200 trading days. It is not closed. It is not narrowed. If anything, it has widened. The premium held through the entire dump. Let me explain why that matters. In a functioning, efficient global market, if gold is $28 cheaper in London than in Shanghai, arbitrageurs would buy in London and sell in Shanghai until the gap closes. That's basic economics. The fact that this premium has persisted for over 200 trading days means one of two things. Either the arbitrage is being blocked, meaning physical metal cannot flow freely from west to east, or the demand in China is so relentless that arbitrageurs can't source enough London metal to close the gap. Either interpretation tells you the same thing. The West is still pricing gold like 2019. The East is pricing it like something has already changed. Wall Street is not confused. They know exactly what this means. Here's what they filed at 3 a.m. that nobody is talking about. In the most recent Commitment of Traders report, released by the CFTC every Friday, usually buried in a 40-page PDF that mainstream media never covers, the category of traders known as managed money holds net long positions in gold futures equivalent to approximately 18.4 million ounces. That's their bet that gold goes higher. Fine, that's normal. But the commercials, the banks, the dealers, the swap dealers, who are essentially the market-making infrastructure of the COMEX system, they are net short 21.7 million ounces. They have sold paper gold they don't physically own against a market that is trying to buy physical gold that doesn't exist in sufficient quantities. This is not a new setup, but the size of it, 21.7 million ounces short on the commercial side against 8.4 million ounces of registered physical, is at its widest divergence since April 2011. You know what happened in April 2011? Gold hit an interim high near $1,575, was slammed down in a coordinated selling event, and then, 4 months later, proceeded to reach its then all-time high of $1,921. The slam didn't stop the move. It created the reloading point for the next leg higher. This number doesn't exist in a fair market. Now let me bring in a third data stream. The GLD ETF, the world's largest gold-backed exchange-traded fund, has seen outflows of approximately 43 tons over the last 90 days. Institutional investors are pulling gold out of the ETF wrapper. When you redeem GLD shares for the underlying metal, you are converting paper gold exposure into physical gold bars. You're choosing the vault over the ticker. At the same time, the U.S. Mint reported that American Gold Eagle sales in the first quarter of 2026 were up 67% year over year. Retail buyers are also choosing physical over paper. Paper is being redeemed for physical at both the institutional and retail level simultaneously. That is extraordinarily rare. And it has only happened during periods of genuine systemic stress, 2008, the COVID shock of early 2020, and right now. Why did JP Morgan reclassify 13 million ounces of silver equivalent exposure from its derivative book in the last regulatory cycle? How can 51 paper claims exist for every registered ounce of gold at COMEX? What happens to every portfolio on the planet when these ratios normalize? These are not rhetorical questions. They have answers, and the answers are in the price. If you're still with me, and this is making sense to you, and I suspect it is because you're still here, then you are not a Type 1 viewer. Type 1 is watching the gold price hit $3,100 and panicking that they missed it. They're thinking about chasing it at all-time highs because FOMO has replaced analysis. That's a dangerous place to be. Type 2 is sitting on cash or equities, frozen. They've seen the gold headlines, they intellectually understand something is wrong, but they haven't connected the data points into a coherent picture. So they wait. And waiting at this specific moment in history has its own cost. Type 3 is you. You're watching a COMEX vault report. You're tracking the Shanghai premium. You're reading commitment of traders data on a Friday afternoon. You already hold some physical. And right now, you're trying to understand whether this is the setup for the move you've been waiting for, or whether it's a trap designed to shake out exactly the people who've been right all along. If this is clicking, subscribe to The Hidden Economy right now, because what I'm about to walk you through in the final section is the part that determines everything. This is not financial advice, but the pattern I'm about to describe has preceded every major wealth transfer event in modern financial history. Let's be precise about what a warning signal means. Gold is not predicting a crash because gold is magic. Gold is reflecting a crash because gold is honest. It cannot be printed. It cannot be rehypothecated into infinity. It cannot be bailed out. When smart money loses faith in the system, not the company, not the sector, the system, gold is where they go. Not because they love gold, because they need something that cannot be devalued by a 3 a.m. Fed decision. And right now, the data shows that central banks around the world have purchased over 1,000 tons of gold in each of the last 3 consecutive years. That is a record streak with no parallel in modern central bank history. Not since the Bretton Woods system collapsed in 1971 have central banks accumulated gold at this pace for this many consecutive years. Ask yourself one question. Why would central banks, the very institutions that create money, the entities that have historically been the sellers of gold, why would they become net buyers at this scale unless they were hedging against something specific? They are not hedging against inflation. They have tools for inflation. They raise rates. They tighten. They manage. They are hedging against dollar credibility, against the possibility that the reserve currency system as it currently exists undergoes a structural change. And when the institutions that run the dollar system start buying the asset that exists outside the dollar system, that is the signal of signals. The West is still pricing this like 2019. The East already repriced it. Here's what the equity market is missing. The S&P 500 currently trades at a cyclically adjusted price-to-earnings ratio, the Shiller CAPE ratio, of approximately 34. The historical average is 16.8. That means equities are priced at roughly twice their long-term average valuation. In the 130-year history of this metric, the CAPE ratio has been above 30 only 3 times before: 1929, the late 1990s dot-com peak, and 2021. After each of those 3 episodes, the S&P 500 declined by no less than 35% from its peak. 3 times this ratio has been above 30. 3 times it has corrected violently. This is the 4th time. Once is accident, twice is coincidence, 3 times is policy, 4 times is gravity. And here's what makes this cycle different from the previous 3. In 1929, the Fed could lower rates dramatically and stimulate. They didn't, but they could have. In the late 1990s, the Fed had rates in the 5 to 6% range, with room to cut 500 basis points if needed. In 2008, the Fed had rates near 5.24% and cut aggressively, and still needed to expand the balance sheet by $4 trillion to prevent systemic collapse. Today, the Fed funds rate is approximately 4.2445%. The balance sheet is $7.1 trillion, already bloated. If a correction hits equity markets and the Fed wants to respond the way it has in every prior cycle, more liquidity, more money printing, more quantitative easing, they will be monetizing debt in an environment where the dollar is already under scrutiny from 140 countries actively discussing alternatives to the SWIFT payment system. That is not a recession scenario. That is a structural confidence event. And that's not the part that should concern you most. The part that should concern you is what happens to the paper gold system when physical demand overwhelms supply. Here's how this works mechanically. COMEX gold futures settle primarily in cash. Most traders never take physical delivery. They roll their contracts forward, taking profits or losses in dollars. The system functions on the assumption that the paper and physical prices will converge at expiry, that no matter how many paper ounces are outstanding, the price of a real ounce will stay anchored to the futures price because you can always take delivery if you want. But what happens when delivery demand overwhelms registered supply? What happens when 8.4 million ounces of registered physical gold is facing delivery demands that approach or exceed that number in a single contract month? We have never had a full COMEX gold default. Never. But we have come close. In March 2020, during the COVID panic, the spread between London spot gold and COMEX gold futures blew out to over $70 per ounce, a spread that had never existed before. Banks that normally arbitrage that spread couldn't get physical gold from London to New York because flights were grounded. The paper price and the physical price diverged. That gap didn't close for 11 days. 11 days with a paper market and the real market were pricing the same ounce of gold at $70 apart. And the physical sellers, the coin dealers, the bullion banks, the refiners, they priced to the physical market, not the paper market, which meant if you wanted to actually own gold in those 11 days, you paid $70 more per ounce than COMEX said you should. Now imagine that gap is not $70. Imagine that gap is $300 or $500. Imagine that gap persists not for 11 days, but for 11 weeks. Paper says one price. The vault says something different. That's not a prediction. That is a documented historical event that already happened once on a small scale. The question is whether the conditions today, 6.1 to 1 paper to registered ratio, persistent Shanghai premium, central bank accumulation at record pace, institutional GLD redemptions, CAPE at 34, whether those conditions create a larger version of what we already saw in March 2020. Wall Street is not confused. They know exactly what this means. The question is whether you know it too, before the price moves, not after. Now let me speak directly to where you are right now. If you're holding physical gold or silver, the message is simple. Do not be shaken by nominal price drops in the paper market. If COMEX decides to dump paper contracts to engineer a correction, and they have done this 11 times in the last 14 years, always on low-volume trading windows like Sunday nights or pre-market Tuesday mornings, your physical metal doesn't reprice. The premium held through the entire dump, every time. Shanghai held the bid, dealers held their premiums, the paper price moved, the real market barely flinched. If you're holding gold ETFs like GLD or IAU, understand what you actually own. You own a claim on a metal that is stored in a vault managed by a custodian under rules that allow sub-custodians and do not explicitly prohibit rehypothecation. You are one legal document away from your gold position becoming a cash settlement at whatever price COMEX decides to print on the day of a crisis. That is not the same as holding a gold coin in your hand. If you're heavily exposed to equities and you've been watching the gold signal and thinking, I'll deal with it later, later is a strategy for normal markets. This is not a normal market. The CAPE ratio of 34, the inverted paper physical ratio, the central bank accumulation, the Shanghai premium, these signals do not fire simultaneously unless something is already changing under the surface. This is not financial advice. Your money, your decisions. But I will tell you this. The people who acted on these same signals in late 2007 and early 2008, the ones who reduced equity exposure and increased hard asset exposure before Lehman collapsed, those people didn't just preserve wealth. They positioned to acquire assets at a fraction of their future value when the panic reset prices. The wealth transfer always happens. The question is, which side of it you're on. Now here's the 3 types of people watching this video right now. Type 1 is watching gold at $3,100 and they're angry. They sold their gold stack 6 months ago because the mainstream told them it was overvalued. Now they're watching the price, and they're emotional. They're going to chase it at the high because the emotion of missing out is stronger than the discipline of waiting. That decision will hurt them. Type 2 is watching this and nodding, but they're frozen. They understand the thesis. They agree with the data, but they're waiting for more confirmation. Let me wait until the Fed meeting. Let me see what happens at the next COMEX expiry. Type 2 is always waiting for certainty in a market that rewards anticipation, not confirmation. By the time Type 2 is comfortable, the setup is already over. Type 3 already holds physical. They've been tracking the vault reports. They're not panicking at paper price dips because they understand that paper and physical are two different things, operating in two different realities right now. They're watching this video to sharpen their thinking, to add data points to a thesis they've already built. And they're asking one question: is this the moment I add more? Or is this the moment I hold steady and wait for the institutional panic to create a better entry? If you're Type 3, and I think you are, subscribe to The Hidden Economy and hit the notification bell. Because the next 3 to 6 months are going to generate more content, more signals, and more data than this channel has ever had to cover. The April COMEX expiry is 18 days away. The next Fed decision is in 5 weeks. The next Chinese gold import data drops in 4 days. These are not random dates. They are scheduled moments when the paper market and the physical market will be forced to interact, and the results of those interactions will tell us exactly where we are in this cycle. Send this video to one person you care about who has their retirement in a standard 60-40 portfolio, not to scare them, to give them data. Most people will never see this analysis. The mainstream financial media gets paid by the institutions that benefit from you staying in paper. This channel doesn't, which is why we can say what they won't. Drop your gold price target for end of 2026 in the comments. I read every single one. And if this breakdown changed how you see the market right now, drop VAULT in the comments. I want to know how many of you are tracking the physical side of this equation. Let me close with this. The last 4 times in history that gold diverged this significantly from equity valuations: 1929, 1971, 1980, 2008. What followed was not a gentle correction. What followed was a repricing of reality. A moment where the paper promises that financial markets run on were revealed to be worth less than people thought. And in every single one of those episodes, the people who held real assets, land, gold, productive capacity, came out the other side with their wealth intact or expanded. The people who held the most paper came out with the largest losses. We are not in 2019. We are not in 2021. We are somewhere in the vicinity of late 2007 or early 2008. The signals are not identical, but the structure is similar enough that ignoring them requires a deliberate choice to look away. Gold is not warning you because it's panicking. Gold is warning you because it is, and has always been, the most honest price signal in the history of human commerce. It has no earnings to manipulate, no quarterly guidance to massage, no PR department, no lobby in Washington. It simply reflects what the people who understand money actually believe about the future of the system that manages money. And right now, what gold believes is this: something is about to break. The S&P 500 hasn't priced that in. The bond market is starting to. The currency markets are starting to. And gold priced it in 3 months ago at $2,600 per ounce and has been screaming louder with every subsequent week. Paper says the system is fine. The vault says something different. The question is not whether you believe gold. The question is whether you believe the 6.1-to-1 ratio can persist indefinitely. Whether you believe 140 central banks simultaneously buying gold at record pace is coincidence. Whether you believe the Shanghai premium holding through 200 consecutive trading days means nothing. Once you understand the ratio, the price action makes sense. All of it. The spike, the paper slams, the recovery, the new highs, the cycle repeating. Same playbook, same actors, same outcome, just with larger numbers and higher stakes. And the final question, the one I'll be answering in detail in the next video, is this. The April COMEX gold futures contract expires on April 28th. As of today, open interest in that contract has not declined at the rate it normally should at this point in the delivery cycle. Historically, the 21-day countdown to expiry sees open interest fall by 40 to 60% as traders roll their positions forward. Right now, it has fallen by only 17%. That means an abnormally large number of paper gold contracts are still open, still outstanding, still unrolled, with less than 3 weeks until they must either be settled in cash or converted to physical delivery demands against a registered vault that holds 8.4 million ounces. The math of what happens if even 5% of that open interest demands physical delivery will be the subject of the next video. The date is April 28th. Write it down. This is not financial advice. Your money, your decisions.